Hello, everyone. Thank you for joining us today in what is yet another sort of timely moment to talk about the energy markets. I'm Rachel Ziamba. I'm a non-resident fellow at the Gulf International Forum and also an adjunct senior fellow for the Center for New American Security, where I focus in those capacities. I focus on energy markets, the role of governments in markets and sovereign funds. I'm joined today by three great panelists who are experts across the energy field and in the intersection between politics and markets. We're going to talk today about where we stand in global oil and gas markets. This has been a tumultuous and very interesting year and a half for energy markets, with major demand shocks last year from COVID lockdowns and eventually some policy and market supply responses. We're going to talk today a lot about how some of the country's supply responses have been calibrated and whether they're up to the task of planning for the different macro and fundamental scenarios and the politics of this. Throughout all of this, the OPEC Plus group, including OPEC and many like-minded or not so like-minded producers, have been a major part in stabilization of oil markets, moving to drawdowns in inventories and some degree of stabilization. But most recently, we've seen, as is perhaps unsurprising, initial cracks in cohesion and question marks and divergence perhaps on what the medium-term outlook looks like and who should share the cost of adjustment. Today, we're going to talk about how that plays out in oil markets, in natural gas markets, and what the future might hold. I'm going to introduce each of the panelists and then turn to them in sequence, and then we're going to have lots of time for your questions. Please ask them at any time and I think we've just shown you can send them on chat, you can comment on any of the social media platforms, and we will work them in. We have with us today Neil Atkinson, who's an oil market analyst with over 40 years tracking the international oil industry. Many of you know him best as the former head of the Oil Industry and Markets Division of the IEA, where he and his team produced the Oil Market Outlook and many long-term and medium-term forecast documents that people like myself have grown to rely on. Next, we have Professor Brenda Schaefer, who is an expert on energy and geopolitics in the Caspian, Middle East, Eastern Mediterranean, and many other issues. She is on the faculty of the Naval Postgraduate School and a senior advisor at the Foundation for Defense of Democracies and senior fellow at the Atlantic Council's Global Energy Center. Third, we have Abhi Rajendran, who's director of research and advisory at Energy Intelligence, where he leads the North America-focused research on oil and gas across all aspects of the supply chain. He's also adjunct research scholar at Columbia University Center on Global Energy Policy. And I would say one of the more entertaining and useful energy Twitter feeds that I follow and interact with. So if you don't follow any of these individuals on Twitter and other platforms and read their work, I would go ahead and do that. But before that, listen to what they have to say. I have only briefly summarized all of their accomplishments. Those are in the invite. I want to spend time listening to what they have to say about energy markets. So do consult that for all of their other expertise. First, I'd like to turn to Neil for his opening thoughts around oil and energy market fundamentals. Neil, how are you seeing those fundamentals? How are you seeing the outlook following the recent OPEC Plus agreement? Do you think those plans are consistent? Are OPEC Plus ahead of the curve, behind the curve? Maybe I'm looking wrongly at the curve. Related to that, how are you seeing issues of cohesion? And then are there other risks that you're seeing? And I'm sure you'll have some thoughts about the UAE Saudi Arabia split. With that, let me hand over to you for your thoughts and on these and related topics. Oops, Neil, I'm afraid you might be muted.
Okay, I think I'm now unmuted. So thank you very much for the invitation to participate today. It's much appreciated. Good evening from live from Paris, which none of you will have had the opportunity to visit this year, unfortunately. Hope to see you again soon. So what I'm going to do in the next few minutes is just give you some thoughts on where we stand with the short-term oil market, then move on to some medium-term issues. And then I'm going to offer some very specific thoughts about the United Arab Emirates and its relationship going forward with the OPEC countries and the OPEC Plus process. But as far as the current market is concerned, in the last few days, we've seen a little bit of a fallback in oil prices. Now, being on this side of the Atlantic, you must excuse me for being a Brent guy. That's the currency that I tend to speak in. And in the last few days, we've seen Brent slide back from a fairly comfortable range of $65 to $75 a barrel that we've seen since February. The price range we have had, 65 to 75, strikes me as being very fair for both the producers and the consumers. As far as the producers are concerned, memories are still fresh of the collapse in demand and prices that we saw in the second quarter of 2020 as the pandemic took hold. And this range we've been running in, 65 to 75, has gone a long way towards restoring their battered budgets. It's not been the total cure, of course, but it's gone a long way. At the same time, higher prices have not yet stimulated a strong recovery in US oil production. As far as consumers are concerned, and of course, I must note, of course, that we were reminded in the last week or so that we must bow down to the interests of the godlike United States gasoline buyer. We've seen prices rise about 35% since the beginning of this year. But it's unlikely that the price rises that we have seen are going to be a major impediment to demand growth, particularly because in the developed world, there is some evidence that due to COVID-19 concerns, consumers are shunning public transport in favor of private cars. And by the way, US gasoline prices currently, I think, on the national average number, I know obviously the average conceals higher and lower prices, of about, what, $3.20 a gallon, something like that. I looked up, and in the first half of the last decade, US prices averaged $3.40 for the whole period. So $3.20 is not perhaps quite as much of a crisis as the United States seemed to want to suggest last week. But I digress. On the consumption side, there are some countries that are vulnerable to exchange rate movements versus the US dollar at the same time as dollar prices for oil are rising. And in the case of some countries, that is a major concern that they have indeed expressed. India is a very good example of that. But even though India may have its problems with relation to prices, I guess it's gratifying that gasoline demand has reached record highs in July. It's gratifying because it means that the Indian economy is recovering. The main concern as far as oil demand is concerned in the short term in the major consuming countries is the Delta variant. Will that force lockdowns in major consuming countries, particularly, of course, the United States and China? But on the assumption that this doesn't happen, and that is the consideration that I'm working on, then oil demand is on course to return to the pre-pandemic level of 100 million barrels a day during the second half of 2022. Indeed, demand in the United States, looking at the most recent figures, has recovered to pretty close to the pre-COVID level. And indeed, if international air travel was not experiencing very specific problems due to COVID and customer reluctance to fly, the global demand would already have returned to pre-pandemic levels. Even in the short term, though, even so, in the short term, recent movements in the price curve suggest that the market is not as strong as the boosters of $100 a barrel of oil that were very prominent a few weeks ago would have us believe. The narrowing of the 6-month Brent price spread from over $4 a barrel to just above $2 suggests that markets remain reasonably tight, but not as tight as some people like to think. So for the time being, despite the current turbulence we're seeing in markets, I anticipate that the Brent price will remain within the $65 to $75 a barrel range. Now, as we look to 2022, the picture gets more complicated. So let's assume that demand continues to recover and there is no major lockdown that impedes that recovery. On the supply side, OPEC Plus have told us very explicitly that production will increase by 0.4 million barrels per day per month, starting in August, as they continue to unwind the enormous cuts they made in the early part of 2020. So by the end of the first quarter of 2022, production on the basis of that plan will be over 3 million barrels per day higher than in July. And I'm excluding from any consideration here any significant increase in supply from Iran.
Hello, we seem to have lost Neil. My apologies. Perhaps we can he'll come back and rejoin. Though please speak up, Neil, if you're back with us. Perhaps I could behind the scenes we'll do a little bit of shuffling. Perhaps at this point, perhaps at this point we could we'll give him a moment to rejoin. There you are, Neil. You're back with us.
Okay, I'm sorry. I will
let you pick up. Oh, well,
I did nothing.
Sometimes I believe you were telling us that you weren't factoring in any Iranian barrels, additional meaningful Iranian barrels.
What I was going on to say that we've got lots of oil coming from OPEC Plus according to their plan. Meanwhile, in the non-OPEC world, current expectations are that production will rise pretty significantly, maybe up to 1 million barrels a day from the United States. Other volumes expected from Canada, Brazil, Norway, and some little bits and pieces from some other countries. So there's a lot of supply coming into the market in 2022, and that increase in supply based on current plans from OPEC Plus looks likely to be greater than the expected increase in demand. And that, of course, is going to place pressure on prices. So a major overhang is potentially on the cards in 2022. And this would suggest to me that OPEC Plus's supply policy will need to be revised to avoid potentially significant downward pressure on prices. Just a few remarks on the state of OPEC Plus. The OPEC Plus process overall has actually been a great success, particularly since April 2020. Compliance with the agreement has generally been very high, and Saudi Arabia has augmented the agreement with significant voluntary cuts. Of course, we shouldn't forget that in early 2020, just as the pandemic was beginning to take hold, Russia and Saudi Arabia were engaged in a pretty tough market share war. But of course, the collapse of demand and prices brought them to their senses, and they faced reality and cooperated. I think that in the short term, the next few years, the Declaration of Cooperation, the OPEC Plus agreement, will hold as OPEC attempts to keep prices within a tolerable range against the background of the uncertainties posed to demand by the pandemic, and as it watches to see if increases in production from, for example, the United States are perhaps more significant than currently anticipated, or indeed less. But looking a little bit further into the future for the Declaration of Cooperation, the energy transition is underway at some pace or other, and that can be debated. And there is pressure on the international oil companies to divert investment away from fossil fuels to clean energy. However, I very strongly believe that oil demand will continue to grow throughout the 2020s. There are still very hard to substitute sectors, including aviation, shipping, long distance trucking, petrochemicals. And in 2020, EV sales were only, I think, about 4 to 5% of global vehicle sales. So there's still plenty of headwind behind oil demand. But if at the same time as demand will continue to grow, we have seen since the collapse of oil prices after 2014, 2015, significant impact on upstream oil and gas investment. Oil investment fell 25% in 2 years, I think 2016 and 2017, and only really recovered very modestly up to the pandemic period. In 2020, of course, we've seen a major impact on investment. So unless investment picks up in the fairly near future, and that must be open to doubt, on the assumption that demand continues to grow, by the middle part of this decade, there is a risk that at that time, the global spare capacity cushion could become extremely thin. And that would be so even if Iranian production were to return to normal levels. And that, of course, could lead to a spike in oil prices, which would, of course, be good for the OPEC Plus members and indeed the other producers. But such a spike could hasten the trend away from fossil fuels and provide only a short window of opportunity before OPEC Plus perhaps faces the existential threat or the existential challenge of peak oil demand some point in 2030 or thereafter. So there is a danger, in fact, that in this situation, we could see a free-for-all with those countries with spare capacity and the capability to add capacity more quickly, taking advantage. So the cooperation that we have seen could break down faced with this scenario. And that would, of course, mean that the weaker brethren within the OPEC Plus agreement would be disadvantaged. That is a nice segue into the final point I wanted to make, which relates specifically to the United Arab Emirates. And this will not take too much longer. I worked for Petroleos de Venezuela for a very long time. And in the 1990s, I recall very vividly that PDVSA was expanding its production, its current production, in excess of the OPEC quota. It had publicly announced that it was going to expand its production capacity through to the middle, through to about 2005, significantly, using international oil companies to aid that investment program. And PDVSA, excuse me, was beginning to act very independently of the government, but also very independently of the formal commitments that the country, Venezuela, had made to the OPEC organization in terms of production. Now, I see some parallels with what is happening in the UAE, and more specifically, Abu Dhabi. Abu Dhabi has already invested significantly in boosting production capacity, up to about 4 million barrels a day now. It has aspirations to raise it to 5 million by 2030. The Abu Dhabi authorities, the ADNOC company, can see that maybe in 10 years' time, there is this existential challenge to the international oil and gas industry, and they are looking to take advantage of the investments that they have made to gain as much market share as soon as possible to gain the maximum advantage before we move into the new era. So I think ADNOC might be plotting an independent path, and how that is going to be accommodated within the existing OPEC Plus structure to maintain the cooperation with, say, Saudi Arabia, that is a very difficult issue to understand, and maybe some people with comments might want to shed some light on that. I'll end at that point because I think I've gone over my time, and I hope there's a little bit of food for thought there, which people will find useful. Thank you very much.
Thanks very much, Neil. And I think some of those topics are ones we'll very much come back to, particularly around Iran, but particularly around not only this question of what sort of path the UAE is charting as being one of the few sort of countries investing in adding capacity, and particularly adding capacity in an environment where many international oil companies have large, net zero commitments, and there's questions about the role of national oil companies versus privately held ones, but also what other countries might want to, on paper, maintain larger shares, but may or may not be able to do it. With that, I'd like to turn over to Professor Brenda Schaefer to take us to sort of have us do a spot check on where we are in the natural gas markets. And of course, Brenda, we'd welcome your comments and reflections on the oil markets as well. But I think one of the things that's been very interesting this year has been not only this sort of rise and spike in the natural gas prices, the sort of additional, even greater inventory drawdowns, particularly question marks about Russian natural gas policy beyond sort of what might have been in the press around pipeline politics, and particularly in this environment where we have record heat in many areas and therefore record demand for cooling, a sort of fundamental outlook. So any thoughts you can share about the state of the natural gas market, and also any thoughts about how the sort of recovery in demand that we've seen across the energy space might be impacted by plans to increase the role of renewables and decrease the role of fossil fuels. I know you have lots to add in this area, so I'll hand it over to you for your thoughts.
Thank you, Rachel, and thank you for this. I'm glad to be a part of this excellent panel. So if you listen to policymakers, journalists, pundits, think tankers in the West, there's an assumption that we're in an energy transition, meaning that we're going from a system that was based on certain fuel mix to a different system with a different fuel mix. And in the past, when we've had these energy transitions, whether it's been from wood to coal, coal to oil, oil to a diversity, which with a strong component for natural gas. There's been either a technological catalyst or there's been a market catalyst with new supplies or dramatic price changes, or generally even a combination of both. What we've had here with this so-called energy transition is actually an aspiration, meaning we haven't really had a technological jump through, complete jump or a complete, price environment change. But we've had as an aspiration, and that's left us with a situation which I think Neil explained very well about the oil market. But we're seeing this in gas markets as well, where demand is still there. Nothing has changed in the demand changes for natural gas. But supplies are being hit by a variety of factors, but some of them being policy issues, and therefore we see this very huge rise in natural gas prices. But also actually other oil as well, but coal would probably the most interesting development. But natural gas prices in a variety of markets. So kind of like where someone wants to go on a diet and they're deciding, hey, I'll cut back food production, but before I actually cut away the demand for the food, and it could have some dangerous consequences. And I think one of the first geopolitical consequences, and I think Rachel, you hinted at this in your introduction, is that it's going to be very difficult publicly to produce oil and gas and certainly coal in Europe and the United States. But since that demand is not going away, we're just going to see increased relative production of companies in the Middle East, in Asia, in the former Soviet space. And that has huge geopolitical implications, because if we've spent about 60 years, going from a place where OPEC produced about 70% of the global oil production to a place that in the 90s it was down to about 35%, and in the last 2 decades, really seeing a plurality in oil and gas markets of the producers. If this trend continues, we're going to see, a return to certain, only certain geographic areas producing oil and gas, state companies versus private companies, and that's not going to make one dent in the emission picture. If at all, it could maybe even make it worse, but certainly in terms of pollution, because in general, the state oil and gas companies tend to, and smaller companies also tend to fare worse in terms of their environment and climate policies. And I would say another thing that the U.S. Really, without any public discussion, studies, hearings, sort of bet on one technology, which is electricity, meaning that the energy transition means moving over to electricity. Again, without a public debate, without hearings, without really a discussion. And this kind of reminds me of what happened 15 years ago with biofuels, where suddenly, this was the answer. We want to lower dependence on the Middle East, so upping biofuels, all these subsidies, incentives in Europe, in the United States. And then suddenly looking at the stats, the statistics, and saying, hey, this doesn't really, this at best lowers fossil fuel consumption by 12%. That was the best case scenario. Doesn't do much for prices. There's environmental impact. You're trucking these biofuels to stations. Even the food prices, like a lot of unintended consequences until we walked back from it. I wouldn't be surprised if something with electricity happens similar, because if you even just think, if the US government truly believed, or the administration truly believed, we were in an existential crisis on climate, and that's maybe already some things that were irreversible, and some of these factors, some of these developments might be only 10 years away. Why would you actually sanction a massive infrastructure building project, even if it's a part of it is a transition to electricity, meaning that even if you thought that in the long run this could reduce emissions, and why would you, if truly climate was at a sensitive turning point, why would you unleash this huge building period and production period, manufacturing period that clearly would raise emissions? Even if in the end of the day you believe that this would lower emissions. That's one point. Second point is that I think maybe the American public has no idea that green has been substituted by clean. Clean sounds good. Who's actually, I like clean. Everyone likes clean, right? It sounds very good, but this wording that suddenly we've gone over, if you look at U.S. Department of Energy websites, other U.S. government documents, the word green has completely disappeared. It's been replaced by clean energy. Clean energy means lower emissions. It doesn't necessarily mean, like green, low environmental impact. I think most of the U.S. public has no idea that clean energy, as the administration is advocating, can have huge environmental impact. The largest source of renewable energy is hydroelectricity. I think before they get the green label, just because they're renewable, people should go take some looks at hydro plants. They should look at ecological systems before and after a dam has gone in. Even in terms of emissions, it's not clear that hydropower is so good, with methane being released, in the waters in the process, right? So I think we need a whole new look in America, at least, about the difference between clean, which is low emissions, and green, which is low environmental impact, and renewable energy. And I think the American public might have a different approach to it. Another aspect of so going back to this, if the energy transition means a major aspect of it difficult to produce oil and gas in the West, but still easy outside of Europe and the United States, this is a huge commercial opportunity for companies in the former Soviet space, Middle East, Asia. The demand is still there. But the geopolitics of producing it in Europe and the U.S. is what's changed. Another thing to look at with the current high prices for gas and the fact that during the summer, really the storage volumes have not been filled in Europe. And so we see this sort of impending natural gas crisis, especially in Europe. A couple factors. One, the hubs. So is Gazprom not releasing, what it regularly does, release to the hubs, to auctions? Is that geopolitics? Is that some sort of shortage in Russia? It's something that definitely needs to be looked at. By the way, it was always clear, this idea of going over to hub pricing, always, very enthusiastic by different commercial entities, right? But it was clear that Gazprom would always be the major trader at these hubs, and of course would have immense influence over the price trends there. So we really need to be, keeping an eye on that. And a good case study that I don't think many have done. Last winter, when gas was short, where they were hot, there was a cold spell in Europe and a cold spell in Asia at the same time. LNG was it more, cargoes went to Asia versus Europe, and there was a huge price spike and shortages in Europe. And what did Europe do? Northern Europe, especially, I recall, especially in Sweden, moved over to heavy oil. So just saying no more fossil fuels in the end of the day may mean that instead of having clean natural gas, clean in the sense of non-polluting natural gas, you're still going to need to heat your homes, and without having a backup, it's just going to mean actually more demand for oil. And then just a couple more points on oil post-COVID environment, higher built-in demands for plastics with more use of disposables and medical equipment, lower demand for public transportation, and higher demand for driving. So probably not going to see any of that going away for a long time. And I'll just make one point also, joining in with Neil, about Iran, something. So short run, probably the current geopolitical conditions give more opportunity for Iran to release oil to the market, with the U.S. not release. Iran basically has been exporting a lot of oil, relatively to being under sanctions. With the current U.S. geopolitical situation, it's hard to imagine U.S. really clamps down on that export. So in the short run, we'll probably see a little bit more Iranian oil into the market. In the long run, keep an eye on what's been happening in Khuzestan, Ahwaz city, and around. These demonstrations at the center, the epicenter of Iran's oil and gas production, were very, very serious this summer. There's been a lot of arrests. There's not a lot of media coverage, but the situation in Awaz area, Khuzestan, is very serious, and it could actually even disrupt some of the Iranian oil and gas production. So, thank you.
Thank you very much, Brenda. I think you raised really important points about how we need to holistically look at costs of different supplies in the short and sort of longer term, and maybe even more of a call for some standard ways of measuring some of those and the trade-offs. In particular, I think we'll probably come back to this question, Mark, on also some of the pricing dynamics. Abi, I'd like to turn to you, to sort of bring some of these themes together, to share your thoughts on oil fundamentals. Neil mentioned at the outset that sort of the price range we're at now seems like a fair price. I'd be interested in thinking about whether you agree, what you think the risks are to that. And where you see the balance of risks on the demand side from Asia, obviously on the supply side from some of the countries we've been talking about, just any thoughts in this area, and then we'll sort of follow up with a few of the good questions we're starting to get in from the audience. Before I hand over to Abi, I want to sort of send out another suggestion to the audience. Please submit your questions via the chat function, via Twitter. We'll keep our folks behind the scenes busy collecting them. We really want to make sure we answer your questions, because this is a very big topic, and we've got a bunch of people that can really address many elements. So with that, let me hand over to Avi, who I think has some interesting and provocative pictures about the energy markets for us to look at.
Great. Thanks so much, Rachel. Yeah, I mean, I think, both my fellow panelists, Neil and Brenda have done a great job highlighting some of the key aspects of what's going on in the oil markets, some of the key debates, both on the demand and supply sides. And, and really, I thought, I agree with a lot of those points. I thought it'd be useful to just show a couple of visuals and a couple of charts to support that in terms of our views and then how I'm kind of thinking about the market over the short term, but also over the medium to long term. And with regard to prices, I thought maybe I would start there before diving into both the demand and supply sides of the ledger. But this is something that we've been saying since the depths of the COVID downturn in the spring of last year, that coming out of this, we really thought that 70 was going to emerge as the new 60, right? Before we used to sort of talk about 60 to 65 being the kind of the normalized price for oil. And we think that's been moved higher, and Neil talked about kind of a 65 to 75 range. I think that's pretty spot on, and what we've sort of seen in terms of oil price action over the last several months. I think we're probably, maybe going to skew a little bit more to the top half of that. So I'm going to say, kind of 70 to 75 is sort of the range to think about over the next couple of years. And look, I think consensus expectations, the forward curve has kind of run up in the short term. But if you think about where many still expect oil prices to be over the next couple of years, and you can see this on the chart here, both for Brent on the left and for WTI on the right. The expectations still kind of taper off, right? The kind of the normalized price is still kind of in that 60 to 65 range, whether you're talking about Brent or TI. And we think at least for the next 5 years that you should be thinking about kind of a higher floor for prices, or sort of a magnet price for oil to come back to if it shoots too much to the upside or drops too much to the downside. Just want to talk through a couple of points on why. So on the demand side of the ledger, I think demand has kind of gone through a lot of fits and starts. Obviously, last year was a whole separate story, but even since kind of the late part of last year through the spring and the summer, and now some of these Delta variant fears, it's been a little bit of a roller coaster ride, right? This is something that we expected. We didn't think that that the demand recovery was going to be just kind of straight up and to the right, getting back to pre-COVID levels. Now, Neil sort of talked about an expectation that we should get back to pre-COVID levels of demand, sometime in the second half of next year. We generally agree. You can kind of see it from the orange line on this slide. We think kind of demand gets back to that 102 million barrel a day sort of threshold in the second half of next year. And that's, I would say, generally, kind of within consensus. We think the path between now and there, we've said this for some time, that it's going to be, very different than this kind of up and to the right cadence for demand. And let me show that to you in this chart. So what this chart shows, is kind of the monthly change in demand, right? So the sequential monthly change, from now to, all the way through the end of next year. And this is something that we've been saying for a while, that, demand has kind of been on this sugar high over the last couple of months of really a seasonal pickup in demand, as Neil talked about, led by the U.S., and as Europe has kind of come out of lockdowns and restrictions, you've seen the same effect there. But one thing we've said is, look, once you get past August, we effectively see no demand recovery sequentially, till about the early part of next year, right? So, there's going to be kind of ups and downs. September is down a bit because you get past that summer high. And then you see a little bit of a rebound in the fourth quarter as some of these Asian markets come back. But generally speaking, it's a pretty flattish picture for the next 6 months. And this is something that I think the market is slowly coming to grips with, right? We were at 75 plus just a couple of weeks ago, and now we're struggling to hold on to 65. And I think this kind of growth expectation reset is something that the market is facing. But once you kind of flip the calendar to 2022, we think that that steady grind higher in demand, getting back to pre-COVID levels, as some of these kind of lagging sectors like air travel pick back up, and you have continued growth in gasoline and diesel and petchem demand, you'll kind of grind back to that 102 million barrel a day threshold. One point I wanted to make, looking a little bit more medium term on demand, right? Neil talked about this and Brenda as well in the context of energy transition and where we're headed. If you look at the chart on the top here, we expect, again, as I mentioned, demand to get back to pre-COVID levels the second half of next year, and then it's growth from there, right? So despite kind of growing energy transition pressures, despite growing focus on the climate and emissions and whatnot, actual consumption, actual demand is going to take quite a while to sort of shift and dislocate. And Neil touched on it. We think the 2020s is effectively kind of a growth market for oil and liquids demand, year in, year out, with the peak really only coming later in the decade. And Rachel, you asked this question just kind of thinking about some of the key regions, right? Some of the key drivers of demand. If you look at the chart on the bottom, if you just sort of normalize this back to where we were pre-COVID at the end of 2019, a lot of different regions have effectively gotten back to where they were already. And yes, there've been a few bumps in the road, like India a couple of months ago with their COVID flare-up. You're seeing issues in China, Southeast Asia, right now. But we think, again, these are all largely transient. And if you look at next year, effectively every region slowly catches up and gets back to pre-COVID levels. And some of the key growth markets like India, Latin America, parts of Southeast Asia are already beyond, right? So these are, again, kind of your key engines driving growth, where even though Europe is transitioning away, even though the US has bounced back, we think it plateaus out over the next couple of years. There are still strong demand growth engines in India, especially Southeast Asia, as well as Africa, Latin America, and other parts of the world, which I think are worth flagging. I just wanted to touch on just two more things before handing it back to you. Neil talked about OPEC Plus, doing a pretty amazing job, balancing the market and keeping things in check, and limiting sort of downside drops for prices. We expect this to continue to be sort of the short-term dynamic. We'll kind of leave it to Q&A in terms of what we expect in terms of market management for OPEC, but generally OPEC is here to sort of limit any drops in prices, and to support the market and really sort of bring it back into a soft landing in terms of where the inventory pictures should get to over the next several months. And being that support mechanism that's there while demand takes its own time to catch up to pre-COVID levels. But one of the kind of the talking points that that were out there a month or two ago, or that OPEC is really sort of going to run out of supply, run out of capacity, right? And things are going to get really tight. We don't think so. I mean, yes, if oil had normalized today, we think it would have led to much higher prices. But we think there is time for OPEC to kind of get that spare capacity working over the next 12 to 18 months. And we think there's a decent amount of it. As Neil mentioned, there are certainly haves and have-nots within the group. But between Saudi Arabia, UAE, Russia, Kuwait, and a couple of members, we think there's enough spare capacity to balance markets over the the medium term. Just to put some numbers around it, right? We think demand this summer reached a high of around 99 million barrels a day. And you need another 4 or 5 million barrels a day of supply to get you back to where you will be at the end of next year, early the following year. We think there's enough within OPEC Plus to do that. Regardless of what happens with Iran. And as both my fellow panelists were saying, Iran will just kind of hang in there, right, despite what happens with with the JCPOA discussion. And during this, the next 12 to 18 months, non-OPEC supply is also growing, right? So that it'll also, gradually come back to help balance the markets and kind of prevent any runaway in prices. Just the one last chart I wanted to show before kicking it back to you. We also see, kind of underinvestment and kind of the pressures around the transition and climate and emissions, limiting how quickly CapEx and investment can come back, especially in non-OPEC and in Western countries. So if you think about kind of the balance of markets looking over the medium to longer term, this is kind of how we view that supply and demand picture. On the blue bars here are demand. And we expect demand to continue to grow over the next 10 years. Peak later this decade, and then and then go into decline in the 2030s. It's certainly possible the decline happens, a little bit, in a more accelerated fashion in the 2030s. But on the supply side, there are certainly going to be limitations on non-OPEC supply, right? Especially ex Russia and Kazakhstan and some of those states. We think peak non-OPEC supply potentially already happened pre-COVID, and even though you get back there, over the next couple of years, you're not going to exceed that level. Especially in the U.S. market, where we think we certainly hit peak pre-COVID. And as Neil said, this is going to put this is really going to put the onus on OPEC Plus to really be there to balance the market, bring on as much capacity expansion as they can, within the states that have the capacity to do so, and really be there to kind of serve the market. And certainly in kind of the middle part of this decade, if underinvestment becomes kind of a prolonged theme, that can really kind of strain prices. If that balance gets really tight and that spare capacity gets drawn down. And just to sort of wrap it up, I mean, this is really why we see kind of 70 as the new 60 in terms of where the normalized price for markets will be, not just over the short term, but really over the next 5 to 7 years. So I thought I'd leave it on that note, and Rachel, hand it back to you.
Thanks very much. And actually, one of the questions that's come in from the audience is explicitly on that sort of point and question mark about what sort of price points, whether Brent or WTI, will be necessary to sort of incentivize oil industry capex. And obviously that number might end up being a bit different depending on jurisdictions and regulation and the like, but I think very much on people's minds. Neil, I wonder if you have thoughts about that, the price point, and then maybe Abby, we can come back to you, and then I'll throw out a couple of questions. We've been getting quite a number of questions in, but there's plenty of time. If you in the audience have a burning question, don't hesitate. We want to make sure we're answering yours, and I'm sure there's a panel that is capable of doing a lightning round or two if we have to. Neil, any thoughts about that question mark of a price level to incentivize needed capex? Oh, sorry, you might still be on mute.
Ring a ding ding. Here we go. Okay, this ties in a little bit with some remarks Brenda made, actually, which I thought were quite good.
We may have lost Neil again, but happy to chime in, Rachel.
I believe we may have lost Neil, but I'm sure he'll be back. Abby, since you were talking, perhaps you could add, and then we'll come to then perhaps we can come to Brenda. I'm sure Neil will rejoin us in a moment. Please go ahead, Abby.
Sure. Yeah. I mean, it's a great question, and I think a key part of that question comes back to how much OPEC plus spare capacity there is, right? I think right now, while OPEC still has 5 to 6 million barrels a day of cuts in place, this is OPEC plus. There is still a disincentive for any sort of capex increases to come back anytime soon, regardless of the price, right? Even if, oil was sort of headed to 80, right? Not too long ago, even if oil had gone to 80, 85, the fact that OPEC was still sitting there with a lot of dry powder, meant that investors were sort of saying, look, we don't need your supply or your capex right now. So I think it's less of a price question in the short term, but if you just sort of, maybe fast forward to, let's say 12 to 18 months from now, when OPEC has unwound, a large portion of those cuts, and if we are, still at 75 to 80, and we think we're going to be, at least our view is that we think we're going to be comfortably over 70, then, we think in that 12 to 18 month window is when investors will, be more open to allowing capex to move higher. Now, by the way, it is already the base case of many companies, including the European majors, to increase capex over the next 3 to 5 years, right? It's, at the current levels of spending, it's not even possible to keep production flat for many of these companies. And so capex has to move higher. The pace at which it can move higher is certainly going to be a function of price. And if OPEC, if demand is come back strongly, OPEC has largely wound down their cuts, and we're sitting at 80, 85. We think that's going to be sort of the window where where that toggle will be shifted. In part to prevent price from going to 90 to 100, right, and really sort of derailing economic recoveries, consumption, and those sort of things. So I think that's sort of the price point to think about from an oil standpoint, and of course keeping in mind the level of OPEC plus cuts. But interestingly, and Brenda can probably add some more color on this. I think in the next 6 months, we're already at the point where we can start talking about increasing gas capex, because there is no OPEC for gas markets, and the strain in terms of gas supply is already being felt today, and winter is still a couple of months away.
Yeah, perhaps Brenda, as I turn to you, maybe I could add an additional sort of wrinkle to that question mark about capex. There's been a certain amount of discussions, but maybe not a lot of action recently, but discussions of natural gas producers focusing on kind of whole supply chain emissions. Qatar sort of branding some cargoes as cleaner. I mean, this goes back to comments you made in your remarks about what's clean and what's green, and what are the whole holistic costs. Neil, glad to have you back with us. We'll come back to you in a moment. But I'm interested, and we've also seen Canadian producers label some of their cargoes as sort of focused on those sort of whole supply chain sort of emissions. So I'm interested in your thoughts on both maybe this question mark about the price points and competitiveness on gas markets in some key areas, especially Russia. But any thoughts you have on this as sort of push towards perhaps as marketing, but also as commitment to sort of regulations to brand and track emissions in a different way. What are your thoughts on how this might shape decisions going forward?
Along this,
Brenda, I'm afraid I'm not hearing you. Sorry.
Can you hear me?
Yes, we hear you now.
Okay,
yes,
great.
We hear you now. Sorry to miss your insight.
Yeah. So, I mean, definitely, I agree with you that there's a trend to look at the whole supply chain emissions and to those that have lower emissions to market this fact. But it's interesting that other industries don't have to be held to the same standard. Like, for instance, whenever you see comparison between EVs versus gasoline-based engines, you never get any analysis of the mining emissions, for instance, that went into place for the minerals and the materials to create the EVs, to create the electric systems, to create the batteries. I mean, if people really saw, first thing physically saw in terms of the human cost of what mining looks like around the world, but most of the rare earths and relevant minerals for electric systems are mined in countries where most of their electricity is produced by coal, right? So if you put the whole actually emissions picture of electricity, I think I think policymakers, at least or true or authentic publics, would be, quite shocked. That the electricity looks so nice and clean and green to them because they just see the end product. But how all these materials are produced. Yeah. Yeah, I mean, I think the same problem. I agree with Abhi's point that in a way, oil's in a better position because there are some adults in the oil market versus gas, which is a variety of markets, and also oil is just so much more flexible that it could respond quicker to some kind of price signals that, but we're seeing, like, if you look at, for instance, the TAP pipeline, which is part of the Southern Gas Corridor, had an auction for future capacity with no bids, meaning that there was a sense that gas, there isn't a an increased market for gas in Southern Europe. When actually, if you look at the demand needs, it's it's exactly the opposite. But it was more about, I think, companies not wanting to commit to natural gas, even if there's a market signal. So I think we have this huge disconnect where it's not anymore about market signals, but it's more about policies. And I think, Rachel, the framing of your question is correct, that it's probably more problematic for gas than for oil, because oil can still be herded when there are the proper market demands.
Mm-hmm. Yeah, Neil, I wanted to come back to you, since you were rudely disconnected by the internet or our platform, for any thoughts on this sort of, to finish your thought, but any thoughts you have on the policy signals, because I know you've spent a lot of time modeling that, and how you see that shaping things in the next couple of years, as opposed to the longer term horizon. So,
well, at the IEA, I retained the true faith, and I didn't get involved in modeling the clean energy transition. Couldn't bring myself to do it. This is a policy world now. The IEA laid out the net zero pathway to 2050. You can agree or disagree with it, but there's a lot of proposals in there. International oil companies are coming under enormous shareholder pressure in some instances, to reduce their investments in the fossil fuel development. We have targets coming out of every orifice in nearly every major developed country in the world. Get rid of internal combustion engine vehicles, using natural gas in heating systems, blah, blah, blah. Endless targets. What we are going to see in the next few years, I believe, with the momentum from the COP26 or COP27, whichever one it is, at the end of this year, more momentum behind policies from governments, and policies will eventually lead to implementation. So there is a head of steam. Now, as far as the oil development is concerned, Brenda made this great point in her earlier remarks, which I was trying to say when I got cut off, is that, okay, fine, the Western liberal democracies, we don't like oil and gas. Even in the US and Canada, there were movements to restrict development. But in the Middle East, in the Stans, Africa, I guess, there is Venezuela, if it ever gets off its deathbed, there are enormous resources out there which are available, will continue to be available to be developed, to meet demand, which I consider will be rising throughout this decade. And by the way, when oil demand does eventually peak in 2030, 2035, whenever that day comes, people talk about it sometimes as if it's going to drop off a cliff. And then that's it. It sort of goes to zero the next day. There is still a long tail of oil demand there. And these countries outside of the liberal democracies, the OECD world, are well placed to continue to meet that demand. And most of them, not all, but most of them are relatively low-cost producers. Relatively low-cost producers, Middle East in particular. So I think there is still a big future for oil and gas development, but it will increasingly be outside of the OECD world, the liberal democratic world, if you like, and the Middle Eastern guys will be in a position to clean up.
Thanks very much. And I think in their view, a lot of these Middle Eastern countries view, first of all, if someone's going to have to adjust, it should be the countries with the higher price sort of production costs, but also if you're going to make arguments about carbon budgets, maybe higher carbon budgets. So I want to throw a couple quick questions, though probably ones that we could have spent the whole hour on, but sort of for quick thoughts out before we conclude. One, we've talked a lot about OPEC, but we haven't talked much about the Biden administration's plea to OPEC over the last week. Of course, it's ended up maybe as a case of successful verbal intervention. People like I don't think that's the case. I think that was luck. And I think it had more to do with the Fed's intervention. and the like. But I'm interested to hear your thoughts both on the sort of dynamic between the U.S. and OPEC and what you think, what you would advise the U.S. government to do in this, in these not just short-term but longer-term context. I'd also be interested, a couple of you mentioned Iraq in passing. The audience members are interested in what we can expect from Iraq. Obviously, a country that is interested in continuing to grow its potential capacity. It's been a major producer. How are you thinking about Iraq's ability to continue to deliver going forward? And if any of you have thoughts about Russia in the context of increasing capacity. So I know Neil rightly was responding to my question about the Biden administration, so maybe I'll let you kick off. I'm sure all of you have thoughts about this in your respective areas, so maybe I can ask each of you to give some thoughts on any of the questions I've mentioned.
I'll confine myself to the Biden thing because I don't want to take time away from the others. The US has a history of calling on OPEC to do something at some point or other when it suits its purposes. In April 2020, Trump was begging OPEC to cut production to save the US oil producers. Now Biden is begging OPEC to increase production to save the US gasoline consumers. I mean, there's a long history of this going back over 50 years or so. And I agree with those people that think it's pretty ridiculous that you want to cut back on oil developments in your own country, but you're calling on others to continue to supply you with oil from their countries. I think this was not a very grown-up intervention. And my final point on this, I found it utterly bizarre that the letter from the administration was sent from the National Security Advisor. I mean, really? What was the national security issue at stake here? That's all I say on that, and I'll leave breathing space to my other colleagues on the other points.
Wonderful. I'm sure we'll come back. Brenda, any thoughts on this or any of the other questions?
This would.
Oh, sorry, Brenda, we're having trouble hearing you. Yes, now we can hear you.
Okay. I can concur with Neil that this was completely about, it was about domestic politics. It was signaling to the U.S. public. I mean, it was taking place just as OPEC had made a decision to up production. So it really makes no sense. So it was signaling to the domestic part. And I find something a little untasteful about this because it's just so, all the time it's very easy in the U.S. to beat up on the Middle East boogeyman. It's not that fracker, it's not our banks not going back to investment in U.S. production but it's the Middle East that's that's guilty for what's happening at the pump. So I found that a bit distasteful. But I think one of what's going to happen on sort of domestic energy politics in the U.S. Is that because of this huge tragedy in Afghanistan, I think the administration is sort of over its honeymoon period with the media in the United States and even within the Democratic Party, and realizing, they can make. I hate to see that. It's awful that this is the reason it's happening, but I think there's going to be a lot more scrutiny of policy decisions of the administration that hasn't taken place. So something like, electricity, great, wonderful. No public discussion, no hearings. When thinking, even how just from a pure, cyber perspective, when you had the Secretary of Energy of the U.S. saying, gee, the Colonial Pipeline hack wouldn't have happened if you guys were using EVs like I use. Well, actually, if they're going to have a hack of an electric system, it's going to be a lot worse. It's not going to be one pipeline. It's going to be, all pipelines. And that could go across in the public with no discussion, no media attention. The same thing that maybe for us in the energy world, that calling on OPEC to up production seemed bizarre, right? But mainstream media, didn't really call attention to it. So I think there is going to be a lot more scrutiny of these kind of policy decisions that in the last year have basically, had a honeymoon period.
Yeah, I'll just add, kind of one point.
Yeah, I think you're right. Not a good look. Go ahead, Abhi. Please.
Yeah, no, I was just going to add, my 2 cents to say that, look, I mean, I think there's this kind of this general backdrop of inflation and other issues impacting the consumer. And the administration has, kind of put itself, between a rock and a hard place, with regard to energy markets, right? Because they are, trying to dislocate demand, which is a longer term effect, but really they are dislocating supply, which is having some short term, some serious issues. And this is why, I kind of mentioned the point on gas going into winter. I mean, we're pretty much done with driving season, and Neil touched on it earlier. Like, nobody really cared about gas prices too much, except for a couple of politicians who wanted to put it on Twitter and compare it to last year's prices. But I think where there's a real crisis brewing is on the electricity power side going into this winter, and we got a snapshot of that in the early part of this year. In Texas, and we've seen some sporadic issues this summer too. And I think this is going to be the kind of the front and center debate. With regard to energy markets, especially on supply and prices / costs to the consumer, and kind of layered on top of it, all these kind of additional stimulus measures that are being pushed through, right? Which all infrastructure package, more oil demand, more gas demand, and then if you follow that up with a large budget reconciliation, even more so, right? So all increasingly inflationary and positive for demand over the short term. Where is the supply going to be, right? And going and asking OPEC for it is clearly not a great look.
Yeah, I think we can agree. I think also the other challenge, if it was, and I think you're right, it was very much for a domestic audience, but it also inflamed existing domestic issues, both around domestic production, but also around issues like Keystone Pipeline, which of course, and it's not that sort of exports from Canada really went down in a meaningful way. Some pandemic related tracking, and we can say all we want about sort of oil by rail versus oil by pipeline and other things. So yeah, I agree with you. I think the timing was a bit odd, as well as this sort of begging element. On pipelines, let me throw in one more before we kind of get to concluding remarks. The question has just come in at the 11th hour around Nord Stream 2. And whether it's likely to be in service before the winter and how it might impact. I mean, I understand that it's possible it might be announced as finished very soon, but I know there are many issues around certification in Europe. Brenda, do you have any thoughts about sort of the pipeline trajectory and to what extent Russia is likely to, whether this might just be a displacement of sending, natural gas through that pipeline as another? Are we likely to see net increases in natural gas from Russia to Europe in the coming months?
So I would connect this also to the earlier question about new investments in gas. So, increased consumption of oil can kind of take place without the public seeing it. You don't have to build a new oil port or a new oil tanker. And so, but if you want to bring in new gas to markets, if there is a market need, there's some infrastructure generally needs to be built or expanded, or compressors, and those sort of they're seen more in those investments. And that's why I think I agree with one of the focus of the panel here that one of the biggest disconnects is probably the increased demand for gas, and especially if we're going into more electricity usage, with really no increased production or new pipelines. And when I look at, I monitor most of the new, projects into Europe. One of the biggest and highest paying gas markets, and it's almost impossible to bring new pipeline capacity into Europe. And ironically, it's that the non-Russia capacity is much seems much harder than the Russian capacity. So yeah, I think that that's why we're going to continue to have crises with for heating, crises for electricity. Again, use of more fuel oil. I mean, the irony here is that one of the demand sources for oil in Europe could be actually the shortage of supply of natural gas. You know, so I think there is a systemic problem, and obviously no public will in Europe to talk about, gee, what do we do about our security supply of gas? You know, if you think about projects such as the Southern Gas Corridor, which brought the first new volumes, you know, not just rerouting of existing volumes, but new volumes into Europe, the first new volumes in decades. You know, that was sanctioned in 2013, became operational 2020. Could you imagine another Southern Gas Corridor into Europe? You know, that kind of mega project. It's very difficult to imagine in the current political environment.
Thanks very much, Brenda. Neil, any thoughts about European natural gas? Oh, I'm afraid we can't hear you, or I can't.
I have nothing to add on that. I think we just heard the expert view. I'm just hoping we don't get a cold winter here. That's all.
One only hopes. While I have you, maybe we can do a quick round if any of you have any concluding remarks that you want to leave the audience with. Anything that you didn't get a chance to add, any sort of takeaways, anyone expect any changes at the upcoming OPEC Plus meeting? You can tell from my question, I don't think so, but Neil, any parting thoughts?
I would be astounded if there's any changes at the next meeting. I think they've set a course. I think the idea of having these monthly virtual meetings without the circus that normally descends physically on these events is extremely helpful, and I think has improved the decision making. OPEC Plus since April 2020, I think has played a very difficult hand very, very well indeed. And they have shown that they're willing to be flexible. They're willing to change their strategy if the market conditions persist. As John Maynard Keynes said, when the facts change, so do my opinions. And they will adjust accordingly if in 2022 we are faced with a surplus of supply, which we think currently we are. So I have every faith they will continue to manage the market as effectively as they've done for the last 18 months.
Abby?
Yeah, no, I would agree. I don't expect you know, any change of course quite yet. You know, look, the market, despite the demand issues and worries, has been drawing, you know, 2 million barrels a day or more, you know, over the last couple of weeks, right? And so if OPEC wants to add, you know, 400,000 barrels a day, you know, for a month back into that market, it really shouldn't, you know, change the dynamic up too much. But you know, as Neil was saying, you know, the other thing to watch is watch the price, right? I think what you're seeing the price action right now is, you know, is a lot of these, you know, kind of over optimistic hands that were, you know, in the market, you know, at low 70s, mid 70s, expecting 80 plus on this kind of demand recovery story being shaken out. You know, and if that shakeout means another $5 drop, then yeah, I mean, you know, then you could have, you know, OPEC Plus kind of temporarily take a pause, or, you know, or at least like verbally communicate that. But you know, as long as we're kind of between 65 to 75, as Neil kind of talked about, I think the market is you know, generally okay, and OPEC will see it. So I mean, I would view today's market, you know, kind of the fair price, or kind of the fair value at around 70. So, you know, I think again you're seeing, you know, some positioning and macro related shakeout impacting the price for now. But yeah, I mean, I think the key thing to watch, you know, just one parting thought for me is, you know, is just kind of watch the dynamics heading into 2022, right? I think you're seeing this, you know, this deflation in growth expectations, which generally I think is a good thing. I think there was just too much hype around, you know, a lot of things, not just oil market, but macro wise, heading into the fall. You know, so to kind of level set a little bit, and you know, and then go on from there. I think is a good thing. I'm still confident that there will be, fairly robust demand in the second half of the year, and some decent momentum, heading into next year. But also watch geopolitics. I mean, geopolitics. I think the impact of geopolitics on the actual oil price has basically gone to zero, over the last couple of years. Apart from a few days here and there. But certainly, as Brenda was saying earlier, this administration is now kind of on its back, on its back foot. Watch how they deal with Iran. That's going to be a key variable over the short term. OPEC Plus will be fine, but also domestic energy and broader policy, including stimulus, will be a key set of variables to watch. So I'll just leave it there.
Thanks very much. What about you, Brenda? Any concluding thoughts? I want to give you the chance to have the last word. Oh, sorry, I think you're on mute. I think you're still on mute.
Great. Okay. So actually, Abby's last point is a perfect introduction to my conclusion from this panel. So actually, I took a lot of notes from my other panelists. I learned a lot, and I think there was actually a very the kind of panel where people are not afraid to say that the truth here, and I really enjoyed this. And I think that what's amazing, if we could have a panel on the oil and gas markets 5 years ago, we wouldn't really talk much about geopolitics. And it's kind of like, by having such a diversified oil market, geographically, politically, with gas markets also more diversified, and sort of a lot of enthusiasm in the world about the role of LNG, was kind of like those problems were over. And my notes that I took from some of my colleagues here, I kept thinking, oil, we're like back to the 70s. Gas, we're back to the beginning of the century. I mean, the same kind of geopolitical. I mean, so we're talking about increased concentration of production in the Middle East and greater Middle East, and former Soviet Union, a little bit Africa. Sort of the same model of the 70s. Gas, saying, gee, how are we going to get more infrastructure in? Maybe it was there for, in the past, it wasn't. It was different geopolitical problems, but still, whatever it is, it's still the problem that, infrastructure isn't there, won't be there to meet the demand. And then at the same time, like this big geopolitical problem that everyone wants to go over to electricity, when we see that even in, one of the most or maybe the most technologically and market advanced countries in the world, in the United States, in two of its biggest markets, California and Texas, it cannot provide stable electricity. And we're adding soon, I don't know how much of our audience knows, but New York State is going in a similar situation, closing one of its last major nuclear power plants. And with the governor there saying, yeah, we'll have to muddle along, no substitution for it. So we're pushing electricity to the world when we can't even produce it for, our own publics in Texas, California, New York, three of the richest places in the world.
Thanks very much. And I will say, as a resident of New York, about every time the temperature goes up, I get an alert telling me to turn down my power usage. Though some of that, I think, is that certain places over air condition their locations. But that's a topic for another discussion. But I think this point that we've all sort of made about this question mark about really getting the right sort of infrastructure, navigating this very policy-driven environment. And I think that sort of element of the policy debates and sort of challenges driving is in my mind even more than the geopolitics. I think this is something sort of very new, the interplay between policy, geopolitics, and markets, whether that are sort of new regulations, sanctions. This whole environment has shifted. So it leaves me to thank our panelists, to thank you for joining us today, and to please stay in touch on these issues. The forum will no doubt be coming out with other ongoing sort of events on these and other topics. And thank you very much for taking the time today, or if it's some weeks from now that you're watching this video feed. Thanks very much to all of you, and have a good day.
Thank you.